Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, October 24th, 5:28 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in a moderate correction. Checking the trend gauge over here. Market leadership showing the dreaded red bearish downtrend arrow. A little bit of improvement over the last 2 days in leadership, but with the state of the overall market, not the environment to be diving heavy into potential leadership type stocks. Short term, the five major indexes are trending below their 21-day exponential moving average. That gives us the red arrow there also, as well as against the medium term 50-day moving average. The slopes of those lines are negative also. Mixed bag against the 200-day moving average, small, mid, and Dow below their long-term 200-day moving average. S&P 500 after two closes below the 200-day reclaimed it today. NASDAQ 100 continues to be the leading index, firmly above the 200-day moving average. So what happened today? Gap up at the open, long bond yields pulling back a little bit. Tested the 200-day moving average, got above it early in the day, back below it midday, rallied back above it by the end of the day. That's a good sign. Market trying to hold these recent lows above 4,200. So we'll call it a bounce day across the board. You can see the green and the S&P 500 reclaiming the 200-day moving average. Here are the numbers. Big 7 up 1.03%. RG8, this is our 8 growth ETF composite, up 1.2%. S&P 500 gap up 0.5%. Gave up most of that, rallied in the afternoon to close up 0.73%. Similar action on the NASDAQ 100, gapped up 0.5%, and strong action throughout the day, ended up positive by 1.5%. Dow up 0.6, mid caps same. Russell 2000 small caps up 0.82%. Global diversified 60/40 stock and bond up 0.56%. Bond lower duration bonds were basically flat on the day. It was the long bond where the yields pulled back and prices spiked that helped that number to close green. In-house GROTECTION up 0.25%. We came in with about 40% of the allocation of the S&P, made a few portfolio changes. We'll talk about that when we get to the tail of the tape. After hours, two big earnings reports. Google down about 6%, Microsoft up about 4%. We've got Meta after hours on Wednesday and Amazon after hours Thursday, then Apple next week. Those will have a big impact on the indexes going forward. So let's get into the charts, and we'll start as always, or as usual, with the S&P 500. And you can very clearly see the importance of this 4,200 level on the daily chart. It acted as resistance when we were rallying back in January. It acted as resistance as we were trying to go higher in April and May. That was the breakout level in early June. And we're testing and bouncing at that level right now. The 200-day moving average now above that level. That's a pretty good sign, and it's also a sign that if we break below here, we'll be breaking not only the 200-day, but that pretty big horizontal support level. And it'll complete a failed breakout. As of right now, this candle I mentioned in last night's videos, the highs and the lows are important. Intraday, we made a slight higher high. It didn't test the lows, but the lows being below 4,200 and getting back, undercutting and reclaiming those lows from late September, early October. Market's putting up a fight. So maybe it's just a bounce because we were down 4 straight days, or maybe it's truly trying to put in a bottom. We don't predict, but we've got guidelines and rules for all situations that you might see. And let's take a look at one of the rule sets that we used here. This is how we handle the passive allocation of the portfolio when we get near uh, the danger zone being the 200-day moving average. Well, why do we call that the danger zone? Because here are all the 13 bear markets going back to 1970. These all occur below that level. So quite obviously, if you're drawing a line on the chart, and it's very widely followed technical level also, but all these bear markets occur below the 200-day moving average until you break the 200-day decisively, and the slopes of the lines of the moving averages, primarily the 200 and the 150, start to roll over. You're in a normal correction. It's not until you get substantially below that 200-day moving average that you start seeing some of these. And basically, we take the tack that we're going to keep this partial, at least uh, passive approach exposure to the market unless we really start to break down. So looking at it from a floor and ceiling perspective, if we're above the 200-day moving average, um, 0.6 is a minimum of what we're going to have in the S&P 500. As we approach below the 150-day, getting down near around the 200-day, we'll kick it back to about zero point 0.5. If we break the 200-day, and we saw this yesterday, we have a floor as long as we're not more than 2 ATR below the 200-day. We have a floor of 0.40. With the failure at the 200-day yesterday, we dropped it back to this level by the close, but with the reclaim today, added a little bit of exposure back to get it back near the 0.5% level. There may be a little bit of chopping going on around here, but with a pretty clear line in the sand at the 4,200 level and the low of Monday, uh, that tells us that it gives us enough conviction to take a shot here at increasing the exposure back up to zero point 0.5 and not have to drop it unless we would break below the lows of Monday. And again, that would correspond with that 4,200 level. And certainly we'd want to see that last for a couple more days. Often we just make the decisions at the end of the week. But we don't want to, after being down 4 straight days and bouncing, don't know if the bounce is going to be one day. Don't know if we'll fail at the declining 8 EMA. We may get up to the declining 21 EMA. A lot of what the big cap responses to earnings this week are going to be, we'll have something to say about that. But um, taking a little bit more risk on today because the risk reward is there. We know our stop is tight, and it's a line in the sand that the risk reward is in our favor. Moving on to the NASDAQ 100, you can see the line in the sand here is right above this 350 level. And again, key level to focus on. Should we start to pull back here? We're coming into the declining 8 EMA there. This obviously looks a lot better with it being as far above the 200-day moving average that we are, and that is 6.2% above. See down a little bit after hours. That's mostly with Google being down on earnings, down 6%. Microsoft up, not quite making up for that. So we'll see how that unfolds tomorrow. Let's Let's go to the Dow Jones Industrial Average. Again, a bounce at this 33,000 level. We like to see the fact that these key levels across all the big cap indexes kind of line up together here with what we're seeing in the S&P, the Nasdaq 100, and the 33,000 level on the Dow after the 4 down days. 1 day of a bounce, nothing to get too excited about, but again, place to draw a line in the sand under these recent lows. Now onto the lagging indexes, mid caps, kind of an inside day today, anemic bounce, up 0.56% on the day, but it's a start. And again, line in the sand, the lows of Monday, and uh, that applies to the small cap index also. IWM 170 was a really big level, 3-4 closes below it now. Clearly we want to see a rally, but if that what was support level flips to resistance, small caps could continue to have a pretty tough go of it. You can see how awful the relative strength line has been in the small cap index. Let's go to the VIX, which had a spike yesterday and closed near the lows of the day. Uh, Another beneficial move on the VIX corresponded with what we saw in the indexes, breaking back below the ADMA, coming into this 21-day exponential moving average now. And we'll see, the VIX doesn't necessarily obey. It's not going to say, "Oh, I'm at the 21. It's time to bounce." But these are more reference points than anything else because when we were below the 21 and below this 15 level is when the indexes did their best work this year. So that's kind of the level that we're keeping our eye on. If we get above this big spike that we saw yesterday, the indexes will be breaking lower without question. I feel pretty confident about saying that. Let's go to the dollar. Dollar putting in kind of a tight 2-week pattern here now as it pulls back from recent highs with the 21-day exponential moving average holding this pullback. You can see this is forming a handle of a very long cup and handle. We would like to get some cooperation from the dollar with the indexes, but that inverse correlation hasn't been as strong over the last week as it was prior. Let's take a look at how the strong dollar, and we would have normally expected gold and silver stocks to get hit pretty hard here. But again, here's this correlation not keeping in line as gold was flat on the day. A little bit of a pullback for 2 days now after this attempted breakout, but went pretty far pretty fast. Pullback is normal in this situation. Same thing with gold stocks, not as strong as gold below the 200-day moving average, consolidating there also. Uh, Slight positive move on the day, and silver, like negative move on the day, pulling back after a recent strength up. Now, Bitcoin, this is something to talk about. Yesterday, after the close, a story came out that a QSIP had been assigned to the iShares uh, spot Bitcoin ETF, and it was listed in some kind of uh, record keeping system that gave the impression that it was pretty much all but approved. After that story got out, Bitcoin spiked. All the Bitcoin related shares spiked also. And overnight, you can see the big gap, holding most of the gap, closing near the lows of the day. The much better entry into this would have been 16 yesterday, where we saw the follow-on strength after the move off the bottom. We did take on an intraday pullback on 1% position, a starter in Coinbase. Big gap up, a little bit of euphoria because late morning and right around here is when it was. That database entry in the record keeping book for the QSIP for the iShares Bitcoin ETF was removed, and that caused somewhat of the sell off and the pullback in Bitcoin and the Bitcoin related names. But um, this really seems to have the attention of the institutions. Look where the relative strength line is relative to where it was here. Price still lower than this close, but the relative strength line higher. So always want to see relative strength line higher before price. It's last time we had a euphoric move like this was also on rumors of the Bitcoin spot ETF being approved, but also a story yesterday that I mentioned it. The courts telling the SEC to make a decision because they lost the court battle. So we'll see how this plays out. It seems like it's a done deal at some point that a bunch of spot Bitcoin ETFs are going to get approved. At that point, those ETFs will have to buy Bitcoin if shareholders buy their ETFs. And very similar to the way all of them have a SPY ETF, they're all going to have all the major like BlackRock, State Street, Vanguard, the way they all have a SPY ETF or an S&P ETF, they're all going to have a Bitcoin ETF also. And Coinbase is one way to play that. There's several different other ways to play it also, including the spot Bitcoin ETF itself, which will have our attention, provided the price and Bitcoin itself starts to go up. But it really does seem like a recipe for much higher prices. and taking a small position to start here seemed like the prudent thing to do. So that is what we did today. Now let's go to bonds. Broad bond index higher here for the second straight day. Long bond index TLT higher by 1.3%, significantly higher. IEF is the 7 to 10 year. That was just barely up on the day, as you can see there. So where were we on the yields? TYX, this is the 30-year yield dropped 0.52%. The 10-year TNX up mildly, hanging on that 8 EMA. So that is the inter-asset correlation that we discussed. Let's go to the tail of the tape. You can pause this. The important thing, mostly related to the VIX, is that the inversion is gone also. That takes the boot off of the throat of the market when VIX is inverted. It's a very big level of fear and prone to big swings in the market. But with that being gone, that's a positive for the market. Day count, 4 days down, 1 day consolidation now, fifth day below the 8 EMA and the 21 EMA. You can see 10 out of 11 sectors were higher. Uh, Headed definitely by Bitcoin and the Bitcoin complex. Gold and silver, tight moves. 30-year yield down, oil's down, regional banks down, builders down. So in-house, that SSO position that we sold yesterday, that's a representation of the S&P index exposure to take it down to zero point 0.4. We took it back up to 0.5 and added the Bitcoin, or not Bitcoin, the Coinbase. That moved our exposure back from 0 0.4 to 0.54. But the bottom line on the day, bounce day for the indexes and leaders. S&P 500 reclaims the 200-day moving average. We'll see what the reaction to these two big reports is tomorrow. And like I said, the high and the low from Monday, pretty critical as reference points from the standpoint that it was a shakeout below a key level, that being that 4,200 level, also below the 200-day moving average. So a check mark in the column of the bulls for regaining that today, and pullbacks holding above yesterday's close, not going negative. Let's take a look at a couple of stocks. These are leaders that have been bouncing. One of them has earnings in the morning. We'll be keeping an eye on VRT, up 1% after hours because Microsoft, with its cloud service, spending a bunch of money. They provide power equipment to these data centers. So back above after a shakeout below the 50-day, back above the 21. We'll have to see what the reaction is in the morning. Check out the reaction though to some of these names. RTX, Raytheon, they provide the missiles for Israel's Iron Dome. Good guidance, up 7% on 209% average volume. Terrible reaction to last earnings, and then a big gap down here in September, just starting to claw some of that back, getting back above the 21 and above the 50-day moving average. Spotify also had a good reaction to earnings with a gap up here. These all go in the Q4 earnings gap up list. I'll review that periodically in these videos, but and as is typical when you see this, we set an alert at the high and the low of these big volume gap days. But that's a nice move on Spotify and really not a bad looking chart. Going to be profitable next year also. Another one with a good reaction is General Electric. They're spinning off a couple of more companies. Relative strength at a new high, 200% average volume, above average volume, up 6.5%, regaining the key moving averages within a nice flat base here after a stellar run going back to the beginning of the year. And there was one more, MedP, with a big gap up on earnings on 400% above average volume. So all these go on our gap up list. We'll monitor these, and this gives kind of a feeling for the overall market. If it can maintain these gaps, it's very clearly bullish. If it starts giving them up in a major way, just the opposite. Couple of more charts. DraftKings got an upgrade today, trying to get back into the conversation of being a leading stock. back above the 21 and the 50-day moving averages. And Nutanix, NTNX, this was the last remaining leader that we got stopped out of, bounced at the 35 level, regained the 21-day moving average today. Got a list of stocks that are holding up pretty well after some really harsh pullbacks over the last week as the leaders broke down along with the indexes. Mostly Thursday and last Friday was when they came apart. Holding the lows on Monday, making higher highs on Tuesday. That's in line with what's going on with the overall market. And speaking of what's going on with the overall market, this is our expectations versus various conditions. Right here, we're right around an 8% pullback off of the highs. So between the moderate and mild correction uh, spot, and earnings season really kicking into gear this week and next week. We'll see what the reaction is and what the overall market has to say about that. That's going to wrap it. Big thanks to everybody that's clicking like on our videos. All I can say is definite thanks. That's what we provide these. Yes, it's marketing, but a lot of people that won't ever become clients like what we're talking about, like the various indicators that we espouse, and like the portfolio management approach. And I can tell by the kind comments that we get. And all I ask in response is a like for the video. So uh, appreciate your support. You can reach out to me, Don at RevereAsset.com. If you're interested in becoming a client, my partner Dan Stewart is at Dan at RevereAsset.com, or the phone is 855 Real Wealth. That's 855 732 5932. And of course, remember, it's not how much you made in the markets, it's how much of that you can keep. Our flagship portfolio, GROTECTION, is designed to grow during market uptrends, protect during downtrends. And we know the worst of the downtrends all occur below this black line, the 200-day moving average. So walking a tightrope here, trying to hold on to that. And with that, I'll wrap up the video for Tuesday, October 24th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.